Operating had revenues of $170,000, expenses of $164,000, fund balance increased $6,422. Ending fund balance in this fund is $32,142. Okay, the next few pages are your enterprise fund, so it's your water, your sewer. We'll start with water here first. Water has revenues of $1.78 million. You budgeted 1.56, so quite a pretty big span there between what you budgeted and what actually happened, $218,000. Part of that's service charges, so your service charges were greater than what you planned on. Part of that's a transfer in from debt service. On the expenditure side, some of the expenditures that stand out a little bit, water plant. So water plant has expenditures of $533,000. Budgeted $611,000. So your expenditures are below budget by $78,000. Most of that's going to be your repairs and maintenance and your waste removal. I'm going to jump to page 97. Total expenses in the water fund of $1.28 million. You budgeted $1.56, so you're $289,000 below budget in total. Some of that's because we account for things different than how you budget. So you make transfers to debt service to pay off some interfund loans that you have. When you budgeted for that, you account for it as an expenditure. When we account for it, we account for it as a reduction in that debt. So there's a little bit of a difference going on there. Another thing that we do different is we show depreciation expense, which is something you don't budget for. So we've got a couple things that are skewing the numbers here a little bit. Overall, the fund increased its net position by $507,000. In these funds, we call it net position instead of fund balance, but it's basically the same thing. Okay. Next page, wastewater fund. Wastewater revenues, $1.52 million. You budgeted $1.63, so you're below budget by $112,000. This is actually up from last year, the revenues here. You've increased your rates this year. And talking with John and Lori, it sounds like next year that's probably going to be up even higher because when you increased your rates, you didn't do it right at the beginning of the year. You were a few months in. So I would expect that's going to go up even more.
The rate increase for the service charge is much higher than the increase in the past.
Expenditure side, waste plants below budget by $50,000. Otherwise, most of the other expenditures were in line with what you planned on. Net position in this fund decreased by $328,000. If you were to add back your depreciation expense, your depreciation is $675. You still got over $300,000 of positive cash flow coming in. Ending fund balance in this fund is $6.6 million. Okay. Page 100, this is your stormwater. Stormwater doesn't have a lot of activity going on. Revenues of $94,000, expenditures of $91,000. Your ending net position's pretty close to break even. You increased $2,800. Okay, page 101, this is the golf course. Golf course revenues, $459,000. You're about $53,000 higher than budget in the golf course. A good chunk of that's donations. Part of that's also a transfer in from the general fund. Those are both unbudgeted expenses. On the expenditure side, and actually the expenditures span over a few pages, total expenses were $496,000. It's not on this page, it's on page 103. You planned for expenses of $406,000. $90,000 higher than budget on expenditures. And if you look at the areas that maybe jump out that you were above, clubhouse expenses were higher, mostly because of purchasing food and candy and different things like that. Pro shop expenses were also higher than expected, mostly because of some cleanup that you did on your inventory listing this year. So you had some write-offs this year, some old inventory that you
write off of old inventory salary, and then also having to have extra part-time help to cover for the loss of the,
Right.
again,
Right.
our salary columns person.
Yep. So overall, everything said and done, fund balance decreased $36,000. Really close to last year. I think last year was a decrease of $38,000. Ending fund balance in this fund is a deficit of $73,000. Next page is recycling and garbage. This is another fund where there's really not necessarily a lot to save. There's not a lot of activity. Revenues of $463,000, expenditures $450,000. Fund balance increased $12,000. Everyone good so far? I know that was a lot of numbers and not a lot of time. Okay, let's talk a little bit about this new accounting standard you adopted this year. We're going to jump way back in the financials now to page 13.
That'll be 18.
So some of you maybe don't realize this, in your financial statements.
So what's that?
36.
36?
36. Everyone good? Okay, some of you might not realize this, in your financial statements, part of the reason why your financials are so thick, I think we're at about 114 pages this year, is you actually have two different sets of books in here. You have the fund basis financials that we just went through. That's what you're used to seeing on a normal basis. It's just your general governmental account. There's also the government-wide financial statements. And what those government-wide financials do, they take your fund financials, they convert them into a format that's more like what a for-profit or a corporation might see. They add things like capital assets or long-term debt to the balance sheet, and then they present them in a different way. Okay, this new standard affects only your government-wide financial statements, and then your business types, so your water, sewer, golf course financial statements. Doesn't affect like your general fund financials or anything like what we just went through. And what this new standard has done is it's required that the city now reports its own pro rata share of whatever unfunded liability PERA or PERA might have. So if you think about PERA, it's there for your employees' retirement. You put in money every month towards the retirement plans, and then down the road, they're going to pay money out to the employees for their retirement. Right now, they're sitting at a projected unfunded liability, so they've got more future payouts than money that they've currently collected. It's a pretty big number. It's like $4 billion. What the standard has done is it requires any government in Minnesota, or actually nationwide really, to report their share of whatever unfunded liability there might be. In your case, if you go to the liability section on this page, the second to bottom line there says net pension liability. Your share is about $2.4 million. Now this isn't money that you're going to have to write a check out for or anything like that. It's money. It's a way of showing if PERA were to fail, this would be your potential liability. In reality, that likely would never happen. Make sense?
Yeah, one the reasons why is that the state can modify the mandatory contributions for employees and employers to ensure that the revenue is there to fund the retirements as we do it. So.
And it's partially based on investment performance too. If investments are doing really well, all of a sudden that unfunded liability might turn into a fully funded asset. It's hard to say. So PERA hires an actuary every year. They go in and they kind of do whatever actuaries do and figure the number. So, and then they publish that and give it to you to look at. That's where these numbers are coming from. The other piece of this new standard is, if you think about the retirement plans the city participates in, there's PERA, and there's also your Fire Relief Association. So this year, your Fire Relief had an actuarial study done to figure out whether they had an unfunded liability or an asset. That's shown in this, on this page too. So if you go to the asset section on this page, the third to bottom line, it says net pension asset, $361,000. That represents the fire relief. So the fire relief is fully funded. You get an asset for it. Make sense to everyone? I don't normally go through these government-wide financials at city council meetings because I don't think they have as much value to you. But I wanted to go through them today just to make sure that you understood the changes that happened this year. Make sense? Cool. Let's move on. We're going to go to page 113. Everyone there? Okay, so you've heard this part every year that you've been getting an audit for probably 10, 20 years. But these are our internal control findings for the audit. So we've got a lack of segregation of duties. You've had this every year, and this is something really common with a city your size. Actually, the city is much larger than you have this finding as well. Basically, you don't have enough people on staff to do every accounting function separately. Other thing we have on this page, financial statement preparation. We're letting the people that read the financials know that we wrote them for you. If you go to the next page, there's a report on compliance with Minnesota statutes. So each year we go through and we do a number of tests to make sure you're in compliance with Minnesota statutes. We had no findings this year, so everything went pretty. Any questions on the financials? Go a lot at you and not much time.
You got questions for John?
John, I think every nonprofit I've ever served on has that segregation of duties
Yeah,
problems,
Yeah.
so that's very difficult.
very common. Most of our clients have it as well. Can we take just a second and go through this other report that I brought? So what we just did was we went through kind of how the city's doing financially. This talks more about how did the audit go? Do we have any issues? So we're going to jump in, we're going to go to page 2. And then this will go really quick. It talks about if we had any issues with your accounting policies. It talks about if we saw any unusual transactions during the audit. Did we discuss any alternative ways to account for things with management? No issues with any of that. It talks about if you adopted any new accounting standards. Well, you did that. GASB 68 we talked about already. It talks about estimates. So there's estimates in the financial statements. These actuarial studies are a bigger one. Depreciation is another one. Really none that we think is a significant risk in the audit bill. Go to the next page. Corrected and uncorrected misstatements. So what that's talking about is if we go into the audit, we see some things that are wrong. We're not going to just say, oh, you get the bad opinion now and we're done. No, we're going to work with you, we're going to do some tweaks, and we're going to get you from point A to point B to get you to that clean opinion. We actually didn't have to do any of that. We posted some adjustments, but they were all from schedules that Lori gave us. She came up with the numbers, she provided all the information. So that's actually something that's pretty important. That's not something you see a lot with a small city. Most cities have a finding for that. So that's a really good thing. Uncorrected misstatements. What that's talking about is if we're going through the audit and we see something that should change, something that can be tweaked, but it's really small, we can give you that clean opinion and not correct it. We do have a couple things here that we're reporting on, nothing very big at all. Disagreements with management, there weren't any. Consultation with other accountants, what that's talking about is if you don't like the opinion we give us, you call up another firm and say, hey, can you give us a different one? That didn't happen either. no significant issues or difficulties. Everything went really well. Lori and her staff were quick to get us what we need, easy to work with, pretty smooth on it. The last 2 pages in this report are the management letter, and these comments are the same as what we had last year. They both revolve around the golf course. We went through the numbers already, so I'm not going to rehash them necessarily, but the golf course has had a loss over the last few years. It's getting better each year. This year was a little bit better than last year. With the early season starting this year, with the changes you've been making, I'm optimistic that next year is going to look even better again. Other thing we have here, golf course inventory. We've had issues in the past with some of the accounting on the golf course inventory. I'm optimistic. You've got your new POS system. I think things are going to look really good next year.
John, it looks like a lot of it in golf course inventory has to do with keeping track of what we're paying for items, what we're
Correct.
selling for.
Correct.
So we're working on a 25% gross profit to make sure we maintain that.
Yep, that's exactly right. So included things like freight costs in your inventory costs, different things like that. I think that POS is going to help a lot with that. That's really what all I have.
Which started this cataloging, yeah. You know, like I know there's a set of items that are like 8 years old.
Yeah, he's worked hard. Even John actually came out earlier in the year to help identify the inventory cataloging of items. There's just so many old things that had no record of, or had a lot, 5, 6, 10, 12, sometimes even your old piece of inventory. And at the end of this season, we're going to do a full-fledged, basically clearinghouse of what it is that we have, record for, what we know its cost is, and put that into the inventory so that starting next year, we have a good clean set of inventory to work from, so that we're well aware of what we paid for, what we're going to sell it for, and where it's going to sit in terms of liability for us. So, great.
Just to clarify too, the numbers in the audit report related to inventory are accurate. It's just a matter of how much work it takes to get to that accurate number.
Yeah, so once we get everything to a clear point, it'll be much smoother moving forward.
Anyone else got a question for John? No? Thank you very much.
Okay? Thank you.
Thank you. Do you have anything else on there, John, that you wanted to add, or?
No, I think I guess the biggest thing that I want to say, and just so that it's clearly understood, is that we budget based on a cash basis. We're budgeting for revenues and expenditures into individual transactions. We don't fully fund depreciation, even though it's getting accounted for in the auditing statement. When we pay a debt service on that, we're accounting for that as a principal and interest expenditure, and we transfer that out of the debt service accounts that we didn't go through in the audit report because they're not, typical budgeted funds. They have, basically a two count. It's the expense for the principal and interest, and it's the transfer in that we're going to make as the revenue source to pay that. So it creates things a little differently when you're talking about in terms of an audit perspective versus in terms of what we talk about with budgeting. So, for example, specifically with the golf course, they're accounting depreciation into that. We're not cash flowing depreciation. So if you look at the final number that they come up with, take out the depreciation expense that they're reporting and add that back into what shows as a loss or a loss in cash position or fund balance position. You add that back in, it's actually a need. So, factoring that in, but they're also factoring in long-term expenses that we're not accounting for as the day-to-day operations of the golf course. So if we buy a piece of capital equipment and it comes out of the improvement fund, it's not coming out of our operating budget, so that's a cash fund. It's coming out of an improvement fund as capital expense that then they will account for in depreciation over time. So it may not show up, or may not look, it may not look the same as what we talked about in terms of how did the golf course do in operations last year, and it made money. It did make money in terms of the operational expense, but when you factor in depreciation, the acquisition moves up. But that's been something.
So why don't we budget for depreciation?
It's hard because a lot of times, but cash positions can be tight, and if you've ever gotten a project and you paid and it was largely paid for to be a grant, it's hard to depreciate grant revenue dollars that you gain. So it's a matter of practice sometimes to either include that, but I'd say in our case for water and sewer infrastructure, it's going to be really difficult for us to do because those depreciation amounts are going to be huge, and if we had to actually bring in the revenue through rates to pay for that, it's going to, our rates are going to be extreme. We're certainly not going to be in a position where we're competitive with other communities in terms of what those rates are. Yes, those funds that you would fund for depreciation would get set aside and they'd be used to pay for future projects, but we have plans in place in terms of financing them through PFA or other means that we're coming up with those other plans to account for them, so we don't need to do that in terms of depreciation.
Mr. President, I think it's worth noting also that we consistently hear, and I know Lori always deflects the credit, but what a great job she does keeping our finances, keeping a handle on that, because that's been consistent with the auditors, so how easy it is to work with her and how she finds everything, so great job.
Anyone else? Any other questions? Now we'll move on to